is. Otherwise, at the start of the year, see that information there. On 1st November 2021, at the start of the year, the rules of the pension scheme changed to improve or enhance. I hope you remember yesterday, either to improve or enhance or increase the benefits of the members in the scheme, with the actuary advising that this will increase the pension scheme with 202 in form of a past service cost. You see, the examiner is even trying to tell you it's a past service cost. So this question is also examining a past service cost. Debit 1st November 2021. The debit and credit is just like the current service cost. You're debiting the P&L expense and crediting the pension obligation, and therefore you're adjusting the pension obligation brought forward. Remember, the pension obligation brought forward was 693 here. I'm going to adjust it by saying plus the 20 for me to be able to compute the net interest cost. Okay, so at this point, 3 of the 4 things have come. I'm waiting for the 4th that must come. 1, I've seen the contributions received or paid. As a student, I know that one will always be there. I know what to do. Secondly, I've seen the current service cost. I'm telling the examiner that one must be there. Third, will be the remeasurement adjustments to get these figures when I'm adjusting the pension asset and pension obligation. I'll deal with that last. But listen, the interest is there. They are saying the yield on the high corporate bond, quality corporate bond, on 31st October 2021 last year, which will result into the opening figure. And this year, ignore it, year end, we're looking at start of the year, the interest rate is 10%. So the examiner can give you the 2 rates, start of the year and end of year, to see if you're going to get a little bit full. Should I use end of year or start of year? I remember that Monday screen, it was highlighting one of them, which was that. You're taking 10 minutes in the exam. While you're taking 10 minutes, you decide, let me take this 12%. Let me take 12%. I think even what I saw was he was using something like 12%. By the way, I'm talking seriously. They're there. You guys, they're there. I'm very sure it's not one of you in this chat, this call, in this classroom today, but they're there. They're not even here attending this here. You know, I'm fooling myself that they're not here, but I'm praying to God that surely they're not here. But they are there. They are going to be there on the exam. Your exam is 2 weeks or 3 weeks. I don't know how long from now, whichever it is. They are there. People who are going to start struggling between 10% and 12%, even when they're listening to me here. Maybe they're not even listening. They're watching Arsenal play another team, maybe. You know, so I will excuse them and I will see them again next sitting because they were not here. The fun became a cry. They were on football, you know. So don't mind, it's okay, you can watch the football, but I'm just saying, this is where the slight mistakes come from. And people fail to pass the paper because either they are crammers or because they do not even pay attention to the classroom session. Otherwise, those who are not crammers and they're active students, for them, they are just happy to say, again, I'm noting. I noted yesterday that you use the start of year interest rate and you use the adjusted start of year balance. If you're adjusted, if there's any past service cost. So those ones are there. And they're practically enjoying this session, waiting to move on with that practice over the days after the exam time. Those ones are going to just move through smoothly in this question because ICE 19 likely it's there, to be honest, in this format. So let's go back. So they're telling me that for me, I will use 10% of the opening balances that I adjust. They're saying that in the event that the value of the pension plan assets exceeds the pension obligations, in the event that the assets exceed the obligations, which for us we saw yes, at the start, 693 is less than 945. Even when I say 693 plus 202, it will still be less. So the assets of 945 at the start of the year are bigger than even the adjusted open balance of the obligation. Even at the end, the assets of 882 is bigger than the obligations of 731. So we shall have a net pension asset. Now here they are telling you that in the event that you have a net pension asset at the year end, the pension scheme agreement contract with the pension fund manager allows Rafik to only take up or utilize or actually benefit or recover 70% of the pension asset. So yesterday I told you that everyone you have a net pension asset, be careful, don't recognize all of it. Is it possible that you can recover all of it? Here we're told the agreement allows him to only recover 70% of that net pension asset. So the unrecoverable is what yesterday I said implied impairment loss. That pension asset may be impaired. In IS 19, an impairment of a pension asset is recognized in other comprehensive income, not in the P&L like normal impairment losses. By the way, I want to tell you something. You know, I'm happy when I have people who are very, very happy to hear IFRSs. You know, you get to know and you get to feel them the way the church people are able to quote those verses. In IFRS 9, I'm yet to summarize for you IFRS 9. In IFRS 9, and it's only in IFRS 9 where you shall find something called impairment gain. Impairment gain. Otherwise, natural impairments are impairment losses. By word of English, impairment means something has gone down in value. So naturally, they are impairment losses. Mean that because they're impairment losses, they should be debited. Either you're debiting P&L, which is the normal case, apart from IS 19 that says if you have a pension asset impaired, take that impairment to the other comprehensive income. You will ever come to read, I hope your textbooks have that statement, that however in IFRS 9 we can have an impairment gain. Impairment gain. Please, that impairment gain is only related to a debt instrument, not equity instrument. You know, I can invest by buying shares, that's an equity instrument, or I can invest by giving out loans. So if I have a debt instrument, I have given out a loan and I've classified it at fair value through other comprehensive income, which is away from the normal, because normal final debt instruments are classified at amortized cost. Then I can assess its impairment gain in IFRS 9. It's in your syllabus. Okay, so that's the beauty of knowing IFRSs. You just sing them as a song. You can just go to the exam, anything that comes, you know what to do. Okay, back to this. So I'm going to have an impairment loss on this net pension plan asset, which I'll recognize to the OCI. Now, lastly, they're saying, other than the cash book entry for the contributions that were paid or made into the pension plan, where the corresponding entry was even taken to the suspense account, the details of the entire pension have not been recognized in the financial statements. So those are the 7 things we did yesterday. So me, as a student, let's see if I still have that document. Yes, it's the document we did yesterday. So this is what I'll tell the students. That can you see whether these 7 are all there? Because 4 must be there. 1, do you see a current service cost in the scenario, as it must always appear? Yes, from the scenario, the current service cost is there. How much is it? 252. What do I need to tell the examiner? Because this has not been recognized, I'll debit it in the P&L, which in this case retained earnings, credit it on the pension obligations account. So number 1 of the 7 is there. Then I say, the next is there a past service cost, which may be examined? In this case, yes, it was examined. Yes, it's there. How much is it? 202. What do? I'll debit it in the P&L and credit it in the pension obligations account, by taking into account that this is going to adjust the opening balance because dated start of the year. So I'll tell the examiner this is also there. I'm good to go with that. Number 3, do I have a net interest cost? Always it will be there, but I first need to compute it and then recognize it. When I'm computing it, I'm computing it based on the start of their interest rate and the start of their balances, including adjusting the balances, and separately for the interest on the pension obligations and interest on the pension assets. Meaning that interest rate, I'll use the 10%, not the 12%. Compute it. So 10% of the pension asset. The pension asset is 945, interest income. Also 10% of the adjusted opening balance of the pension obligation, which is 693 plus 202. I'll tell the examiner, yes, that one is there, Mr. Examiner, and I have calculated it, and I have a net pension, so a net interest income or net interest expense, which I'm going on to recognize in the P&L and on the net pension account. So that is there, number 3. Contributions paid into the pension scheme must always be there. Yes, it's actually there because it was the first item in the table. It's 441. I'll tell the examiner that one is there. What do I have to do about that, Mr. Examiner? I'll debit it on the pension assets account and credit it on the cash and bank account. Okay? Is there settlements of benefits paid today, employees that have left the exam, it may be there, it may not be there. In this case, yes, it's there as number 5. Benefits paid were 630. So there it is. I'll tell the examiner it's there, 630. What do I do with that? I'll debit the pension obligations and credit the pension assets with 630. So even number 5 is there. Is there a remeasurement adjustment? Yes, it must always be there. Everything that I do, which will help me compute that remeasurement difference, is going to be based on the fact that at the end of the year, for the pension obligations, I'm running it to 731 with the difference between the book carrying amount, which I have, and this fair value being that remeasurement difference. And also all the assets, I'm running it to 882, and that is also going to be giving me a computation of the remeasurement adjustment there. And I'll add those remeasurement adjustments to get the net remeasurement adjustment. So that net remeasurement adjustment could be a net remeasurement gain or loss, which, Mr. Examiner, I must take to the OCI. Okay, I'll take it to the OCI as the corresponding entry goes to the net pension account in there. Is there number 7 asset ceiling, which may be examined? In this case, yes, it's there. It's there because this net pension asset, the difference between 882 and 731, I can only recover 70%. So because of that, that 70% is the asset ceiling. Any excess, in this case 30%, is impairment then. And Mr. Examiner, that impairment, which I'll first compute, and then I'll first compute it, Mr. Examiner. That's the 30% of that amount that I cannot be able to recover. I'll go ahead and recognize it in the group OCI. So that question has all the 7. Moreover, as a note in section A, yesterday I must have told you that IS 19 can be anywhere in the paper, section A or section B. So there are people who are saying it's a lovely day for them if they find it as it is in their question 1, and they're here in this class. They're saying we just wish and hope because we have it all. Why not? Okay, so it's a lovely paper then, right? So note 7 is about IS 19. Now, note 8 says, Simba operates a trade name which was acquired. Now, the beauty of this, first, trade name is an intangible asset. The beauty of this statement is acquired. Now, those are students who have already read IA38 intangible assets, and you're aware that in IAS 38 intangible assets, the stubborn place or point or area is initial recognition, not subsequent recognition or not subsequent measurement. I'll come back to that statement. Subsequent recognition is not subsequent measurement. Or subsequent measurement is not subsequent. So subsequent measurement is not subsequent expenditure. Those are technically different, but normally people in life and students confuse. They think the two are the same. But let me leave that aside. Please, the stubborn area on I-38 is initial recognition. Can I just rush to initially recognize an intangible asset? Don't rush in life until 3 things are in place. 1 is it identifiable? Can I separate that intangible asset and its transaction from the other elements of the business? And I can sell it off without necessarily losing the business as a whole. If the answer is yes, the second question is, can I control? And evidently that control is enforced by courts of law. So to have a copyright, to have a brand, to have a trademark, usually courts will defend you if anybody comes to abuse it. So mean that you control because you can legally enforce it. 3, can I expect future economic benefits to flow to the entity as a result of me having this intangible? If the answer is yes, then you have an intangible asset to recognize. The question is what route or what journey or what door has brought in that intangible asset. There are certain doors that don't open for the intangible asset to enter into your house. That house is the balance sheet house. For example, if the door you're using is the separate acquisition, I went and bought it, like here, I went and acquired it, then that door is always open for the intangible asset to get the balance sheet. But if you're saying the door I want to use is the door called internally generated, that door cannot just open. Especially if the door is internally generated goodwill, it's prohibited. That door will always be permanently locked. We shall not have expenses you've incurred on internally generated goodwill. Open that door to say it's an asset in the balance sheet. We shall always expense. Otherwise, if the door is internally generated, but internally generated research and development, the research bit can never come in, but the development bit can come in if 6 conditions are satisfied there. Otherwise, if the door is the door of the barter exchange, that I got that license, which is an intangible asset, by giving away my cars, then yes, that door can open. We call it the barter exchange door. That barter exchange door can open, But when it opens, the initial measure will be the value or the cost of the asset you gave away, not necessarily the value or monetary value of the intangible asset that's coming through the door. Okay, so that can be coming in. Otherwise, the other door that can open for an intangible asset to get into your balance sheet will be the door through the grant. So if I get a government grant and the government allows me or gives me an intangible asset like a license to operate in a remote area without me paying for that license, then yes, you can initially recognize that intangible asset through a government grant where the debit is intangible asset, the credit is IS20, government grant, and the deferred income in the liabilities, and the value will be the cost you'll have paid if you had paid for that license. Be aware of those doors. I'm using the word doors to say that there's a house that has so many doors and people want to walk in through different doors. That house is the balance sheet, which wants to say, I want to initially recognize that intangible asset. Never use the door called internally generated goodwill. Never use it. It will never open permanently. The door that will permanently be open is the separate acquisition, which is this one that was acquired. When I say that, I will always be happy to enter in the door. It will always be open. So this trade name, which is an intangible asset, separately acquired, is actually going to be recognized with that figure of 330 million as an intangible asset. And this was some years back in November 2018. So it was already recognized in the balance sheet. Okay. Now that trade name has an estimated useful life of 10 years. Now, again, the other thing you should know about intangible assets is the moment they enter into the door, you must amortize them. There are only a few intangible assets that never get amortized. Either that's an intangible asset in the form of a purchased goodwill under IFRS 3, or that's an intangible asset that has not been put into actual commercial use, or that's an intangible asset that has an indefinite useful life. Those ones not amortized, those three. Otherwise, all intangible assets must be amortized and only using straight line method with assumed residue value of 0. So if this has, everyone talk about straight line method, it means divided by years. So if this has 10 years and you have to amortize straight line method, then 0 residue value. So 330 divided by 10 years. From 2018 to this year, I think 3 years have gone, 2019, 2020, 2021. At the start of the year, 3 years out of the 10 years are down. It's associated with Simba's products that are sold in the market. Now, in the financial statement, Simba has included the trade name in the PPE. Is that correct? PPE is a tangible asset. Trade name is an intangible asset. So mean that putting it in PPE is an error. So Simba has put it in the PPE wrong. It should be a standalone line called intangible asset. Okay, and he has put it there at that carrying amount after correctly accounting for amortization. So mean that 330 million minus the 3 years depreciation or 4 years depreciation, because at the end of 2022 is now 4 years. So the value is correct, the net book value. The wrong thing is placing it in PPE rather than the line called intangible assets. Now back to the scenario. The trade name earnings can be separately identified. I hope you remember that identifiability test. Can I separate this intangible asset from the other assets of the business? And can it be sold separate from the rest of the business? If in addition, I can even legally enforce it, therefore I control it, and I expect future economic benefits to flow to the company, then sure, it's an intangible asset. It should not be PPE then. So they're telling me that due to the emergence of a new competitor this year, Simba's market share has dropped. So that's an indicator of impairment loss. Now that takes us to I-36. So after we've dealt with I-38 up to this point, now they are bringing I-36 impairment of assets up from there up to there. So one note can be a combination of IFRSs. So back here, there's an indicator that due to the emergence of a competitor, the market share has significantly fallen down. And consequently, the fair value of this trade name by year end is 184 million. So we're going to call that a recoverable amount. I hope you remember I-36 says determine the recoverable amount, which is the higher of fair value less cost of disposal and the cost. Okay, so if they've not given you if they've given you this fair value, which you can even compare to the other. So we shall now compare that. We shall take that to the recoverable amount and compare it with the carrying amount. If the carrying amount is bigger or higher than the recoverable amount, the asset is impaired. and we should run an adjustment, impairment loss adjustment, and debit it in the P&L and reduce the asset by that impairment loss. So two things there, three things, because Simba is a subsidiary. One, we shall compute the impairment loss. Second, we shall recognize the impairment loss. Third, we shall get the impairment loss 20% to the NCIs, because that trade name sits in Simba, which is a subsidiary. Okay, the last note, Tropical. I hope you remember Tropical was an associate. Is also considered to be a cash generating unit in its own right. They are bringing back I-36 again, impairment losses, where we can have a cash generating unit. That smallest group of assets that are identifiable independently with their own cash flows, independent from other groups or other assets, is what we call a cash generating unit. If there's any impairment loss, we allocate it to the assets in that unit, which should not be current assets. We don't allocate to liabilities. It's only assets, and they should be non-current assets. Now, even those non-current assets should be only those non-current assets whose impairment allocation is in I-36. Otherwise, financial assets whose impairment loss is under IAS, IFRS 9, or pension plan assets whose impairment loss is under IAS 19, don't even include them, even when they're under non-current assets. When you allocate to cash generating unit assets, you start with goodwill until it's zero, then you allocate to the rest on a pro rata basis. Of course, there's also a ceiling there that never allocate to an asset and individually reduce that asset to a figure that's less than zero, or to a figure that's less than its net realizable value. Okay, so here we have a cash generating unit as Tropical, and at the year end, it was determined that its recoverable amount was 2,900 million. Meaning that I'll look at 2,900, but Tropical is my associate, 25% of 2,900 is what I will look at compared to my investment in associate to see whether the carrying amount of my investment in associate is lower than, so it's higher than the 25% of 2,900, which is the recoverable amount. If it's less than, then we shall impair loss or reduce the whole investment in associate. Now, but other than that, we don't have impairment loss on goodwill. A student will be confused. What are you calling that? Goodwill is only in Simba, that's subsidiary. So therefore, whatever we are doing, if you remember somewhere, where we're saying this way to see if there's impairment loss on goodwill under Simba, we have now concluded that it's not there because the statement says in the last statement, there's no impairment loss on goodwill. So that goodwill we computed, I'm looking for it down there, is not impaired. Here it is, this 1259 is not impaired. So if it was impaired, it was going to be partial impairment loss. And that partial impairment loss was only allocated to the parent, but it's not impaired. Okay, so we have all the 9 notes with us. We've read them, we've understood them. In the exam, you should even have taken about 15 minutes to read them and quickly and understand them, because you're going to start enjoying getting easy marks quickly before you get into complicated workings that would now give you harder marks to earn based on the tactic I'm going to give you. So we're going to have a short break of about 10 minutes. Then we'll come back to deal with now the real writing of the answer, which is that consolidated statement of financial position. So a 10 minutes break, then we'll return. Okay, people, so we resume our class and let's go to the document and now prepare or start the easy marks. Okay, so I've moved down to the document. Of course, we've had some workings anyway, but in this case, let's get to the document and put our statement, consolidated statement of financial position as at 31st October 2022. So it is consolidated statement of financial position as at 31st October 2022. Please always in the exam ensure you write the heading appropriately. Fine, you may not get additional marks, but you never know if there's any favor to be given to a student. This student clearly titled these financial statements, you know. A 49 can get to a 50 because of that favor, you know. So you never know. So this is going to be rounded off in million francs. Okay. I'm using a Word document because I started all my things in Word document. So let me maintain it. I would have gone to Excel, but let me maintain my Word document. Okay, I'll exactly pick the structure as given to me in the scenario. Okay, so there you are. So remember that we have seen that Rafik and Simba is a subsidiary, Tropical is an associate. So we're going to consolidate Rafik and Simba across line by line, but not Tropical. Tropical, we shall bring him as an investment in an associate. The first section is assets, non-current assets, and I have PPE. So let me start with that. I'll say that assets. Then I have my non-current assets. Okay. Then PPE. In this paper, you can abbreviate PPE, don't mind. Okay. So I'm picking figures for Rafik and Simba. So Rafik is 7,750. Simba is 1,190. So 7,750 plus 1,190. Please write them in full. Don't just put it on the calculator to say 7,750 on the calculator plus 1,190. No, write this here in full and say plus 1,190. So they're giving you ticks. That 7,750 is half a mark. Even if you've picked it directly from the question, that's the beauty with the question on consolidation. They will still give you that mark for that question, that figure, even if they gave it to you in the scenario. Just like 1,190 is a mark. So those two alone is 1 mark, half. Those are easy marks. Those are the ones I'm calling easy marks. Keep leaving a line in between before you go to the next line. So the next line from the balance sheet is other intangible assets. Again, I'll pick the figure 3,150 and the 150 of Simba. So 3,150 plus 150 of Simba. Okay, so other intangible assets. Other intangible assets, and the figure for the parent is 3,150. The 150 plus the 150 for the subsidiary. So you have a full mark there, half picked. Okay. Then the next is investments. These investments will cancel. They will cancel. But again, you may take advantage. By the way, before that, there will be goodwill. Remember, goodwill will be there. We shall have a working. We already had the working. I'll come and pick it up. Maybe I'll call it working 1, the working we had. And the figure you remember, let me quickly, because that one we did it. The figure we had was 1,259. This figure here, 1,259. So and it was not impaired, so I'll come and put it there. So working 1, it is 1,259. Now, do you realize that I'm not necessarily putting figures in the final columns because they don't mark them from there, except if this is a final figure like this and you picked it and put it here, it's okay, they'll mark it from there if they've not seen it here. Okay, now the investments, which is where I wanted to give you a tip. Those investments, especially because these are investments in other companies, will cancel. But you may, the students will just submit them. They don't even write them. It's okay because their impact is zero. But you never know. The examiner may say, in this case, if a student has put that 2509 and that student had a 49, let me go and give the student that half a mark. And if the student even says minus the 2509 because it's cancelled, and again, I'll give that half a mark, and that 49 becomes a 50. So why don't you take that good chance by putting that investment in Simba and cancelling it to the 2509, and then you are also saying minus the 2509. Then there was also the 749, I think it was 749. Then you wait to see how you'll cancel it, the 749. You'll cancel it later. There are students who may want to cancel it immediately, because in the event that the examiner is to give you that good mark, he wants you to take it off. I would prefer that I can leave it there for now. I'll come to it in the normal course. So this will give me the total non-current assets. The total non-current assets. So if you see, I have picked some marks in there. Half, 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 half. I am not guaranteed of these ones here, but it can happen in the case where I'm being pushed because I had a 48 or 49, and they're trying to assess whether I can still be able to earn a pass. They can come and look for this and say, yes, I did something here. Okay, so this total non-current assets is a subtotal. Even when they're trying to help you, they will not mark it, I can assure you. So you may want to think of not wasting time to get it. But for me here, I will get it for you. Then we go to the current assets. Okay, usually the first there will be inventories. Shall go to double check. Let's see what we have there. Yes, we have inventories, and again the parent plus the subsidiary. So 3492 plus 756. Okay. So 3492. Okay. Plus the 756. Okay. So there you are. Then the next line there is usually trade receivables. I'll go and confirm. Okay, so again, the parent, Rafik, and the subsidiary. Yes, receivables. So I have 1890 plus 378. 1890 plus 378. 1890 plus 378. Okay, so the next line in the current assets is cash and bank. Okay, I have 386, sorry, plus 126. Okay, so cash and bank. Cash and bank. So I have 386 plus the 126. Okay, so that gives you, or that takes us to a total current assets, which is a subtotal. Again, they will not mark it, but put it there. Okay, if you have no time in the exam, don't waste your time getting to that figure. Just like also the total assets. The total assets. Okay, so which is the total, the combination of those two totals added together. Okay. Okay, so then I come to equity and liabilities. And liabilities. Remember that you always start with equity. So I'm now going to start with equity. When I start with equity, I know share capital must always be only the parent share capital. So the ordinary share capital, taking only the parent. In this case, the parent is Rafik. Rafiki's figure. When I go to the balance sheet of Rafiki, the share capital they have is 3,500, that figure there, 3,500. So let's put it there. So 3,500. Okay. Then the next line after share capital is share premium. Again, share premium, just like share capital, I take only the parents, Rafik, the 875. Okay, so share premium. It's each of these figures you're putting in here is earning you half a mark. So 875 share premium. Okay, then I got to look for the next line in there, which is revaluation reserve. Now, revaluation reserve, just like the retained earnings, usually you are going to go with the post-acquisition figure, which could be calculated. But because I see one line, I don't see the parent, the subsidiary. So I can comfortably put the 1545 for the revaluation reserve. Because if the subsidiary had, we would be looking for the post-acquisition revaluation reserve, the subsidiary. For now, I'll take the figure as we have it in there, which is 1545. 1545. Okay. Then that takes me to the retained earnings. Now, the retained earnings, you'll not walk away from a working. You'll need a working for that. Maybe we shall give it working 2 because we already have a working 4. Goodwill, which was working 1. We also have the non-control interests. Non-control interests, because financial statements, so we need the non-control interest, always you'll need a working. And I'll give you a tip that usually this working for retained earnings and non-control interest, especially if the question is consolidated statement of financial position, have them started. So there are 3 workings that become part of your life in this paper: goodwill, retained earnings, and non-control interest. If the question is consolidated P&L, there are 2 workings that become a must: goodwill and the non-control interest. You will not move away from goodwill and non-control interest in this paper as a working in this question. Then consolidated retained earnings may be and usually will be another working if the question has a consolidated statement of financial position to put in there. So all this is called total equity, which is a subtotal, which again they will not mark, but let's put it there. Okay, so we bring in the non-current liabilities now. The non-current liabilities. Okay, so again, we're going to pick them as they are in the scenario. So they've given me, it's only one line actually, long-term borrowings. Again, the parent, 3780 plus the 252 of the subsidiary. So long-term borrowings. Long-term borrowings. Okay, you're picking the parent's figure, which is 3780 plus the subsidiary's figure, which is 252. Okay, so you could leave maybe a couple of lines there to say this is my total, the non-current liabilities. Okay, so that subtotal, they will not mark it, but leave it there. Then you bring in the current liabilities. The current liabilities. Okay. Okay, so again, let's see what they have in there. They have trade and other payables. Again, the parent 4410 plus 504 of Simba, the subsidiary. So trade and other payables. Trade and other payables. Okay, so we're picking the 4410 plus the 504. Okay, again, you leave a line in between, and then you pick the next line, which is the taxes payable. 2520 plus 126, taxes payable. So taxes payable. Okay, so the parent has 2520, then Simba, the subsidiary, has 126. Okay, so leave quite a couple of lines to say that this is my total current liabilities. Total current liabilities. Okay, which is a subtotal, they will not mark, and then eventually you have your total equity and liabilities. Total equity and liabilities. Okay, which is a grand total, they will not mark it. Okay, so you've picked Isemax. More likely you have 5+ already, just by picking exactly the figures they have. In addition, you are also setting working to for the consolidated retained earnings. Working to is your consolidated retained earnings. And you want to pick some marks on it as well. In this consolidated retained earnings, you're saying that I have Rafik and the parent, the subsidiary, though also tropical, you'll get the share of the post-acquisition retained earnings. You can choose to have 3 columns, or you can choose to have 2, the parent and the subsidiary, and you'll bring tropical's figure in the parent's figure to say 25% of that tropical's post-acquisition retained earnings. So let me insert a table here as well. Okay, so I know that I need Simba's figure. Simba is a subsidiary. I need Rafiki's figure. Rafiki is the parent. So Rafiki being the parent, I'm taking 100% of his retained earnings lines. While Simba, as a subsidiary, I'm taking 80% here. We had 80% by the reporting date. 80% of the retained earnings figures. Okay, so I want to pick some easy marks to say the figures we see in the question. The figures we see in the question are the retained earnings at the year end, 31st October 2022, in the statement of financial position. So in the statement of financial position, if I go back, I want to pick that figure for the retained earnings for both the parent and the subsidiary. I think these are the figures 3540 and 768 for the subsidiary. So I come in here to say 3540 and 768. So the examiner will pick those figures there and give you tick, tick, half, half. So you see, you're trying to ensure that all the easy marks, you can quickly pick them immediately. Okay, fine. You also need a working for the non-control interest, which you just want to start somewhere down there. So working 3 is non-control interest that will actually be in the group equity, because you're preparing a group balance sheet. So you're not looking at the non-control interest that will go in the P&L. Okay, so you've opened that working. You'll deal with it as and when you come across items that you need to allocate to the non-control interest in the due course. Okay, perhaps you want to put a table for it as well.
Sir, I can't see your screen.
You can't see it?
Yes.
Is it the case? Can somebody say you can see my screen so that we know the network problem is from this gentleman? Can I see anybody saying you can see it?
You can see.
We
You
can
can
see you.
Yeah, okay. So
Yeah,
the
we
gentleman
are
who
seeing.
cannot see it, please, it's your network problem. So what you do is that you can restart your computer or your tablet or whatever device, so that you don't miss what we are doing. Okay, so at this point, I've also started the working for NSAIDs that such that whatever I find, I can be able to deal with it. Now, what do? I will go to the notes. Those notes were actually helping me address the issues in there. Remember, we started with note 1, which helped us compute goodwill. And that note 1, we already gave it a working. If you go back to that working somewhere up there, I think when I was explaining it, here it is. We said that we have to remeasure the previous shareholding. We debited the goodwill, if you remember. Now, we needed to go and reduce the investments by 650. The beauty is that we've done it. We've done that in our balance sheet. For us, we've taken all the 2509. All the 2509. So we've done that. So mean that as I run to complete the double entries, there's this credit that goes to the P&L of the fair value gain, which I have not yet posted. So mean that I have posted the debit when I did the goodwill. I have posted the credit when I reversed all the 2509, because the 650, which is the fair value of the, sorry, which is the initial carrying amount of the previous 30%, I have done it already when I took off all the 2509. So it's 2509 has the 650. What I've not yet done on this double entry is crediting the P&L, which P&L we don't have. We shall take it to the retained earnings. So we shall credit the retained earnings. That's working number 2. Retained earnings. It's the one we're going to give a credit of 449. So I'm going to open that working 2 and put that 449 in there. So let's go to working 2, which we've opened as our retained earnings. Here it is. Then in here, I'm going to come in and say, so I'll come in here and say the fair value gain. I'm updating fair value gain on the remeasurement of the previous 30% held in Simba. And this is on 1st November 2021. It's coming, let's say, it's coming from my working one where I did that explanation. So that is 449. So that 449 belongs to the parent. When he remeasured his shareholding in Simba, his own. He has a fair value gain of 449. So that's coming from not 1, stroke working 1. Assuming students wanted to find out where is it coming from in the note, it's not 1 or working 1. Okay, so why am I doing that? I don't want to forget the double entry approach for all these 5 things I did. So that one I've dealt with it. I had not posted it yet. Then we went to number 2 to say that cost of investment, which is for the additional acquisition, the one for 10, we have debited it already in goodwill. So that debit is already there. The cash and bank, which received it, is already there. And that cash and bank is already part of my balance sheet where I'm bringing in cash, which is already adjusted. So that cash has already taken care of the credit. So I cannot write it again or post it again to be double counting it. So that number 2 is fully accounted for, both the debit and credit. Number 3 was the end size, where we say that that value is given to the goodwill. We've done that debit, but we've not yet done the credit. So that credit, we have a working number 3 called end size, where we are saying that the initial measure of the end size on the date of action 316, which I'll put to the working number 3 called end size in group equity, 316. So remember, we've opened that working 3, and so far it's empty. Let's go and start using it by saying that the value, the end size value in Simba on acquisition debt. Based on what we have picked from note 1 and working 1 is 316. So I'll place it there. The examiner will give you half a mark, a tick with a half a mark there. So you finish the credit entry because the debit, you've put it in the goodwill working. Okay, so that was item 3 in what we're doing here. So item 3, I've finished the posting of the double entry. Then item 4 is where we had the fair value of the net assets. We credited the goodwill, so this credit is already there. The debit has been taken care of. When in the consolidated balance sheet, we kept bringing the subsidiaries figures. Though the balance sheet has gotten the subsidiaries figures at the end of the year, by now October 2022, when it's even updated. So we have even done something better than what we would have done to say, let's pick the individuals. The individuals have been picked in assets and liabilities, but even further adjusted by 31st October 2022. So don't go back to say, wait, Bruce, let's do that debit. It's already done, line by line, aggregated line by line. Okay. Now, on that, in there is, oh yes, the pre-acquisition reserves. In that 1582 is the pre-acquisition reserves. And again, I'll come back to say that in there, again, is a fair value increase on PPE, which may not have been done. Let's first start with the pre-acquisition reserves of 580. What do we do with pre-acquisition reserves of 580? We omit or take them out of the retained earnings. So we had a working for retained earnings here. I'll come in here and say, let's the pre-acquisition reserves. Let's the pre-acquisition retained earnings. Let's the pre-acquisition retained earnings in Simba. And this I'm picking it from note 1, which is 5, I think, was it 580? Yes, 580. So I'll take it off Simba. So I have 580 taken off. Okay, so still on that item of the net assets, there's also the fair value adjustment, the fair value increase on land. So there's still fair value increase on land in that figure, which was in the note, I think it was 52. So I'll come and put it in here. Perhaps I can put it in here to say that that in addition or included in the net assets, included in the fair value, the net assets is a fair value increase on land. Which land we know is PPE asset of 52 million on the date of acquisition. Which means that on the date of acquisition, this implies that this has been accounted for, or the double entry has been in such a way that they have debited the asset code, or they should debit the asset code PPE, because that's where land sits. Okay, with 52 million. The credit has been taken to be part of the net assets that have been taken off goodwill, being a corresponding entry on the date of acquisition. This has already been included. So this is already included. So I don't have to go back to goodwill to say I am reducing it by 52. It's part of what you said minus 1582. It was in there. So what I've not yet posted is the debit. I'm going to post that debit. But before I post the debit, I need to remind you that by the year end, there's no extra depreciation because this land is not depreciable. So by the year end, which is our 31st October 2022, no extra depreciation arises because land is non-depreciable. No extra depreciation arises as land is non-depreciable. It was clear written. So the only thing I'll do is to debit the PPE with 52. So let me go to the group balance sheet and run that debit, because then my double entry is not complete if I don't put that 52 there, which I'll call fair value increase on land in Simba. Okay, Simba. I'll tell the examiner that please look at one. It's you who told me. I think it's not two. Was it not one or not two? I think it was not two. You told me that there was a fair value increase on land. So what was I doing? I was going through the notes, the statements I made, and I had come up to number 4. Okay, the number 5, I computed goodwill, and that goodwill, I've recognized it. But in the process of computing goodwill, I have taken care of the total purchase consideration, which I've even reversed. You remember? In that total purchase consideration, there's the 1410 and there's the 1099. That 1099 has the 650 and the 449. The 650, those of you who remember why I did not go to cancel it separately, is part of the 1099 and therefore it's part of the 2509. Okay, and there's the 449, which you saw me taking to the retained earnings. Okay, now the 316, remember I've already taken it to the NCI working, number 3, and the 1582, I've also taken it. It has brought me 2 extra things. One, it has brought me the pre-acquisition retained earnings and the fair value increase in land. But now there's the 16, which is the deferred tax. That deferred tax, which I computed here, I had a double entry to say that that debit, I've done it. That 16 is already there in goodwill. But now the credit is what I've not yet done. Let me go to the balance sheet under non-current liabilities and put a deferred tax liability there of 16. Okay, because I need to have my balance sheet complete. So under non-current liabilities, deferred tax liability of 16. So here's my balance sheet. Here the non-current liabilities here. I kept leaving lines all aligned. So here now I have a line which I can use to say deferred tax liability. This comes from my working 1, or even then not 2. Okay, and the figure is 16. The figure is in there 16. Okay, so mean that at that point, if I come back to these things I've already done, okay, I have dealt with the goodwill. I've also dealt with that additional information that came from note 2 that has required me to complete this double entry, including the one on the asset, the 52, which I have already thrown up here. So I've also completed that as well. So what does that tell me? It means that in my notes, note 1 and note 2 is fully done. Those 2 notes are done. I don't want to look at them again. I don't think there's anything I've left in those 2 notes. They're all done. So therefore, my business starts with note 3, where I have an investment in an associate, and I'm going to have a working number 4 for that investment in an associate. Initial cost is 693. Then I'll adjust it with our share, 25% share of the post-acquisition reserves. So let's go and open that working 4. So here's my working 4, which is the investment in associates. Okay, so I need to, if it's okay, let me just keep so that I don't have to keep inserting a new table. I'll take this away. Okay, and I can open this table maybe for other further workings when I come across them, so that I don't have to waste that time opening tables. Okay, so back to my working. That working is the investment in associate, where I'll say that this is based on note number 3. Okay, there was another note I remember down there, which I'll find out the note number, which was also on the associate as a cash generating unit. But let me start with this to say the initial cost, the investment in Tropical. Which Tropical is an associate. And this initial cost was on, this initial cost was on 1st November 21. The frame is 693. 693. So that's the initial cost. So that initial cost is the one that I'm going to say I'm adjusting by my percentage share of the post-acquisition reserves or post-acquisition profits in the associate. Okay, so I'll come into say plus the parent share of the post-acquisition retained earnings in by or at year end 31st 20. To mean that in this case, I'm looking at 25% of, if I look at the retained earnings in the balance sheet of Tropical. So if I go to the balance sheet of Tropical, I see that the retained earnings in Tropical is 245. Yet at the start on the date of acquisition, the retained earnings in note 3 were 28. So 245 minus 28, and I'm taking 25% of that. So 245, which is the figure at 31st October 2022, minus 28, which is the figure at 1st November 2021. So mathematically, I want to get that share of the post-acquisition reserves or post-acquisition profit. So in my calculator, I'll get first in there, down in there, the 245 minus 28. So I have 217, then times 25%. I'm rounding it off full figures, so 54 million. Okay, I hope you know that that 54 million implies that you are debiting this investment in associates. Remember, always be very careful. While the credit is going to go up there in the retained earnings. So my consolidated retained earnings in working 2 is going to receive, is retained earnings, is going to receive the 54. Perhaps I may want to throw it immediately there in number, in working 2 here, where I'll say plus the parent share. The parent is Rafik. Parent who is Rafik. Share of the post-acquisition retained earnings in the associate. Post-acquisition retained earnings in the associate. We know that the associate is, we are picking this right from working 4 below. So that figure is a 54. So 54 goes in Rafik's line or column there. So 54 there. So while the credit, that's the credit, while the debit, you've put it in the investment in associate working. Okay, so At this point, you seem to think that you're done because this here tells me that the carrying amount of the investment in associate, carrying amount investment in associate at 31st October 2022 is the 693 plus the 54. So on my calculator, 693 plus 54 gives me 747. So I have 747. But there was a note which told me that there could be a possible impairment loss if Tropical is a cash generating unit. It was one of the notes down there. Slowly. Actually, it's the last note that Tropical is a cash generating unit in its own right. So at that year end, at 31st October 2022, Rafik determined that the recoverable amount of Tropical Limited was 2,900 million, which is the total recoverable amount. This is the total. So I only need to take my 25% share from that total. Okay? So mean that I'll come back to this working I had open to say that, however, the recoverable amount at 31st October 2022, based on note number 9, is going to be the 2,900 million francs times my percentage share, 25%, which is the parent share. Remember, the parent is Rafik. So our share in there is just 25%. Okay? So mean that this is not 3 and not 9 then, which I've combined. So if I got my calculator, 25% of the 2,900 is 725. So what does this tell me in accordance with I-36? The recoverable amount of 725 is less than the carrying amount. So therefore, this cash generating unit is impaired. So the difference is an impairment loss. The difference is an impairment loss. So we have an impairment loss on the investment in the associate. Remember, they've told me that this investment associate is as a cash generating unit. And that impairment loss is the mathematical difference between the 747 minus the 725. Okay, so my calculator, 747 minus 725 is 22. So I have an impairment loss of 22, which I need to account for. How do I account for the impairment loss? I'll account for the impairment loss by debiting it. I don't have a P&L, so I'll take it the consolidated retained earnings. And remember that this belongs to me, the parent. So the column for the parent, Rafik, while the credit is what I've now reflected here to be the investment in associate. So the investment in associate, that asset suffers this impairment loss as a credit entry. So that credit implies that I'm going to move from 747 to 725 in the group balance sheets. But before that, I'll go to the consolidated retained earnings in working 2 and recognize that impairment loss. So working 2 is here. I'll come in here to say less. Rafik's share. Rafik's share. The impairment loss on the investment in the associate. Which associate is Tropical. Okay, which we are picking from working 4 below. Which we are picking from working 4 below. So that figure is 22 in Rafik's column. We are reducing the retained earnings of Rafik by 22 because of that statement. Okay, when I do that, it means that I'll go to also the investments up there. The investments, perhaps actually I need to come and write its own investment here. Maybe I'll write it in here. I need the investment in the associate. In the associate, this case, that associate is Tropical. And this is after the impairment loss. After the impairment loss. So that investment is 725. 725. Okay, so mean that note you have perhaps started saying, I'm taking off 693 based on note 3, which was that initial cost out of the 749. We shall also later take off the 50 something, which was that wrong classification of a financial asset later. Okay. So, but at this point, I'm done with that working number 4. That working 4 is fully done. I don't need any further thing about this working 4. It's fully done. Okay. Just trying to reduce this table. Okay, so what have I also finished? I've finished the entire note 9 and also the entire note 3. So note 3 is fully done. So we are now moving to note 4. Remember, we have already done something on note 4, that brief explanation. Let's call it working 5, or we shall just refer to it as a note. Do you remember we explained that a sale between Rafik and Simba? I think we wrote it somewhere up there, and yes, here it is. So let's also deal with this, the postings. Of course, we're not going to cancel the intra-group sale at this point because we don't have a P&L to prepare. So I'll leave that for now. Then the next statement, we say that we shall also, okay, so that was the statement. The other was the unrealized profit of 126, where we have this double entry. So we have that double entry. So that double entry, I want us to post it. The 126. Debit the retained earnings, which is a working number 2, and credit PPE with 126. So that's what I'm going to do. So let me start with the credit. Credit the PPE with 126. So here it is. So I'll say PPE, take off the 126, which is the unrealized profit. The unrealized profit in the equipment from Rafik to Simba. Coming from note 4. Okay, so that's the credit. Can we throw the debit now to the working called retained earnings working 2? But again, you're perceiving it from, in this case, you're perceiving it from Simba's point of view. Remember, I hope you know why. Because that asset sits in Simba. No, is it? Is it the case? No, it's not the case. That will actually first, the profit was made by the seller. The seller was Rafik. Rafik is the one that made that profit. So we shall put it in Rafik's financial statements so that that profit is not yet realized by the group because the equipment is still here. So in working 2, I come in here to say less the unrealized profit on the sale equipment by Rafik to Simba. And this is in note number 4. Okay, and that figure is 126 under Rafik. So it's a debit reduces your profits. Okay, in that note, there's also the excess depreciation. Remember, we also have the excess depreciation, which I need to add just to account for, debiting it on the PPE. A debit on the PPE is adding it back. So I'll go to the line called PPE. A debit is a plus. So I'll say plus the 6 is that reversal, the excess depreciation. The excess depreciation, okay, on the equipment in Simba now, because that equipment now is seated in Simba's accounts and it is having that excess depreciation, which I'm reversing out. And this is in note 2. Note 2. Sorry, not 4. In note 4. Okay, so I'm going to do the same. Okay, so I want to go and paste it somewhere. Okay, so if I'm debiting the PPE, I want to credit the group retained earnings with the 6. But this time around, I'll put that 6. So let's go in there in our working 2 and put in that 6. It's a credit, so it's a plus. You're adding it back. You're crediting the P&L. So reversal. of the excess depreciation on the equipment, and that excess depreciation, I'm basically picking it from note 4. Okay, so I'm putting back that 6. Okay, so that 6, I'm putting it back. I'm increasing the retained earnings because they had over-reduced the profits of the company, of the group. Okay, so that was note 4. So that's all you needed in note 4. Okay, so let's go to note 5. Note 5 is where we had a debenture. Please, Rafik bought the debenture from Tropical. Tropical is an associate, so we're not going to reverse that debenture note. Instead, and even then, Tropical correctly presented it in the non-current liabilities. You saw it, the long-term borrowing. The error is in Rafik's financial statements, where he has incorrectly presented the purchase debentures in the line called investment in Tropical. So maybe you just need a slight working number 5, which working the real stuff, a slight working number 5, where you just explain it briefly. So working 5 is the Rafik's purchased venture notes from Tropical in note 5. And first of all, you're saying that this is not an intra-group transaction because Tropical is an associate. So this is not an intra-group transaction, as Tropical is not a subsidiary. Okay, so it's not a subsidiary to Rafik. So mean that we cannot cancel. Instead, the only adjustment is the error in presenting that financial asset, the debenture asset, the debt asset, which is a financial asset, by Rafik, wrongly in that line called investment in Tropical. So he has wrongly put it in the line called investment in Tropical. So I want to go and adjust it out. Adjust it out by debiting it in the right place. The right place is financial assets. Debit it as financial asset as 56. And the credit is taking it out of that asset line called investment, where they've wrongly put it. So this is the correction made, the correction you need. So I need to take it out of that line called investment in Tropical by 56. So meaning that I'll go to my balance sheet and straightforwardly post it there. So in the non-current assets, I'll come, remember you left spaces in there, I'll come in here and say financial asset, where I'll say based on note 5 and working 5, I have a correct presentation of a 56 there, and take it out of the asset called investment in associate. So investments here, where they had put the 56 as part of the 749. So when I take it out there, the 56, based on the error which has been seen or gotten in note number 5, it should be able to clear this line to 0. So this line will be cleared to 0 eventually. So you've credited it out 56 from there and took it to stand on its own under IFRS 9 as a financial asset. Okay, so that means in our case, I'm also done with note 5. So I'm now left with note 6. So note 6 is where we had Rafik selling tractors to a customer under IFRS 15 with the sales value or revenue being 504. But in substance, Rafik has not transferred legal ownership, neither has Rafik transferred physical possession. So that revenue is not going to be validated because control has not passed to the customer. Okay. Secondly, or in addition to that, it also means that that cost of sale, which they've recognized as 315, we shall need to reverse it out because if we didn't have a sale, we cannot also claim to have a cost of sales. So we shall reverse that out, okay, and take it back to inventory. But most importantly is the receivable. The receivable of 378 under IFRS 9 is impaired fully. We shall not recover it. Since it's stated under receivables, I'll clear it out and call it a bad debt expense in the P&L or retained earnings. Okay, I'll ignore the interest which they had not anywhere recognized, the 633. I'll ignore that. Let me just go and have a slight write up on that to support the adjustments I'm going to make, and I'm going to call it working number 6. Okay, so working 6 is Rafik's sale. And illiquid, because that customer has been liquidated. So an illiquid customer or a customer with financial difficulties. You can write whatever you want to write in the exam to describe that customer, whereby you're first going to apply IFRS 15 to say that under IFRS 15, we shall need to reverse. We shall need to reverse the sales revenue in the P&L. P&L we're not preparing, since Rafik still holds both the legal ownership and the physical possession. And the physical possession, the tractors. Because the balance sheet is not prepared. We're not preparing the balance sheet. So the P&L, we are going to have this ignored, as the group P&L is not what we're preparing to reverse that revenue. It's not what we're preparing a balance sheet. So mean that in this case, that first entry, which would have been under IFRS 15, I'll ignore it. But related to it will be the cost of sales. So I'll also reverse cost of sales, the cost of sales, this unsold goods, the unsold goods, by taking it back to inventory. Now, because inventory is in the balance sheet now, that one I'll actually implement it. So the unsold goods, by transferring this back inventory at cost, at their cost. So they gave us that cost, I think it was 3 something. So I'll go back and look at how much was the cost. That cost was 315. So it is 315, that figure there, 315. So I'll come in and say that I'm reversing this back at cost of 315 million. And this means that this reversal would be to debit. I'll debit this back to inventories. Remember that inventories are under current assets. Okay, so that's why I'm putting the 315, while the credit is to take it out of cost of sales. Is our cost of sales are now going to be taken to be the consolidated retained earnings, because that's where they are being summarized. So by 315 million. So that double entry, I need to take care of it. In addition, I'll also say that in accordance with IFRS 9, this receivable is impaired. So under IFRS 9, the trade receivable, under IFRS 9, the trade receivable balance, they give us that figure, the trade receivable balance of. So let's go and see how much have they given us in there as trade receivable. In that note, it's 378. That trade receivable of 378 is fully impaired. Of 378 million is fully impaired and should be fully reversed. It's fully impaired, and therefore we shall have it fully reversed. So We're going to reverse it by debiting it to the P&L or consolidated retained earnings. That's where it's going to go through. Okay, and that will be by 378 million, while the credit, I'll take it to the trade receivables. So my trade receivables receive that credit. So that credit is a case of a write-down. A write-down due to a bad debt. A write-down due to bad debt. So you'll not recover this money. So 378 million. Okay, so let's take these two entries. So first, I'm going to reverse the cost of sales. 315. Okay, so debiting it in inventories and crediting it out of the retained earnings. Okay, so I'll go to my balance sheet up here, sorry, it's up, and run the debit under inventories. So here's inventories. I'll come in here to say plus 315. Okay, and I'll say that these are the unsold tractors. So tractors in not 6 and working 6. Okay, so whereas I do that, I'll come and also go to the retained earnings working, which is working 2, and do the same. Working 2 is here. So I'll add back. Because they had done a minus, I'll add it back. So I'll come in there and say plus 315 plus the cost reversal plus the reversal cost of unsold tractors, which is 315. So it's a credit. So the credit is a plus. So adding it back there as a plus. Okay, fine. Then remember that there was another adjustment on that same, the bad debt or the impairment of the trade receivables. So I'm debiting the consolidated retained earnings and crediting the trade receivables with that 378. So that consolidated retained earnings is this working 2, which I come back here and say a debit is a minus. So I come in here to say less the impairment loss, the bad debt in form of the receivable for the tractors or the receivable from the illiquid customer, which is based on that not 6 and working 6. Yeah, and that figure is 378. 378. So let's put it here. So 378 under Rafiki's figures. Okay, so I'm going to take the credit to the trade receivables side. So in the balance sheet, I had trade receivables under current assets. So here it is. So I'll come in here to say minus, our credit is a minus 378, which is the impairment loss or bad debt that receivable from the liquid customer coming from note 6 or working 6. Now that completes note 6. So note 6 is fully gone. Okay. Then we had note 7, which is the defined benefit pension scheme. So note 7. Remember, this is the one that has all the 6 items, the 6 issues, which we said in this question, in this particular note, they are all examined. We need a working 7. We need a working 7 down there to deal with these. Working 7 down here. So working 7 is Rafiki's defined benefit pension scheme from note number 7. So this comes from note number 7. Okay, so let me create, I need a better table than the table I have down there. So let me start a table that can be able to give me the pension obligations and the pension assets and the net. So I think I need 4 columns. Okay, so mean that I'll need a column for the net. In this case, it's going to be a net pension asset, a column for the pension obligations, and a column for the pension assets. Okay, so this is going to be the pension assets, and this is going to be the pension obligations, and this should be our, in our case, we had net pension assets. Okay, we're given the opening balance at the start of the year based on that note 7, opening balance, which is brought forward from last year. In our case, it's going to be on 1st November 2020, 2021. Okay. So if I look at the information given to me on 1st November 2021, based on the information here, 1st November 2021, the pension obligations were 693, while the pension assets were 945. So 693 and 945. So let's go back to our table here. So 945 is the pension assets, while 693 is the pension obligations. The examiner is going to give you the mark, half a mark, a calculation mark for getting the net figure, which is 945 minus 693. So I have a 252. So 252 is the opening net figure before I adjust. Then I remember that in this case, I had a past service cost, which I want to pick immediately, which is 202. So I have a past service cost. So I'm going to start accounting for the changes in the year. The changes, stroke movement in the year, starting with the past service cost. Changes, stroke movement. Movement in the year. So the changes or movement in the year, the first I'm starting with is the past service cost. Past service cost. And I'm saying that this is the past service cost at the start of the year. At the start of the year, which is going to adjust the opening balance of the pension obligation, and that figure is 202. So that 202, a student should now know that the double entry is that we are debiting the consolidated retained earnings, or the P&L, let me say. We're debiting the P&L. Is that P&L implies that you're taking it to the consolidated retained earnings. R is retained earnings, while the credit is what you've just put to the pension obligations account. Pension obligations. So the credit you posted it there. I'm on the left with the debit to deal with later. So that debit, I'll say, is not yet dealt with. I'll deal with it later. So otherwise, my adjusted or revised opening balance, okay, for the pension obligation is going to be 693 plus 202. 693 plus 202. I have 895. The examiner is going to give you another calculation mark here because you have calculated that figure on your own. Of course, this continues to be 945, and this now becomes the adjustment. The net is 945 minus 895. I now have a 50. So you certainly realize that the 202 has reduced that net pension asset by from the 252, now it's a 50. Okay. Now the other changes, if you remember from the scenario, the other changes is that there are contributions that were received or paid in the pension plan 441. Let's go and post that as well, which is number 2. So number 2 are the contributions paid or received in the pension scheme. The pension scheme. Okay, so those contributions are going to increase the pension assets, and they're increasing the pension assets by the 441. So the double entry, if you remember, that therefore you are debiting the pension assets and that's the increase. And of course, the credit is cash paid, cash. So that debit is fully done. The credit is already in the cash and bank in the balance sheet up there, so you don't have to go back and reopen it. But we've picked the second transaction that was done. The third transaction are benefits paid to those employees leaving the scheme, 630. So let's also put it in our changes as number 3. So number 3 is the benefits paid to the former employees or those employees that are leaving the scheme. Okay, and that figure is going to reduce the pension assets by 603, while it also reduces the pension obligations by 603. Okay, mean that in that case, it's like you're saying that I am debiting pension obligations. That's why they've gone down. Pension obligations have been reduced. And I'm crediting the pension assets. That's why the pension assets have also been reduced, because you've used the pension assets to pay off those obligations. Okay, so that's the third change in the year that has happened, and you've picked it from the information. The fourth change in the year is the current service cost. That 252, the current service cost. So the 252. So again, we know what to do with that 252. But somebody says it's 630. Oh yeah, sorry. So let's revise it. It's 630, not 603. So 630. Thanks for that. So 630. Okay. So that shows people alert. Okay. Now the next is the current service cost, 252. So that's change number 4. Change number 4 is the current service cost. The current service cost. Okay, which is going to increase the pension obligations by 252. So the column for pension obligations, and that's because as I debit the P&L, remember that I don't have a P&L. Instead, I'm going to debit the consolidated retained earnings. Consolidated retained earnings. We receive that debit, while the credit is the pension obligations. That's why the pension obligations have increased with the current service cost. Remember that this is done at the year end, unlike the past service cost, which was done at the year start. So this is at the year end. So as I've credited the pension obligations, but I've not yet done the debit, so let me highlight it that I'll need to deal with that debit at a later stage. Okay, fine. So that's number 4. The number 5, from what I see, is that I think we are given the market values of the pension obligations and pension assets, which is going to help us with the remeasurement adjustments. And we've done there. We've also done the past service cost. So we now have the interest cost now, the net interest cost, where I'm using the start of year interest rate and the start of year adjusted balances. And I want to calculate and then recognize it as my number 5. My number 5 is going to be the net interest cost. The net interest cost. So that net interest cost, I'll start with the pension assets. So the pension assets. So the pension assets, I'm using that 10%, the start of year interest rate, 10% of 10% of the opening balance, that 945 of the pension assets. So the 945. So the 945. So that 10% of 945 is going to give me 94.5, rounded off to 95. Okay. While on the pension obligations, please, the figure on the pension assets is called interest income. This is interest income. But the figure on the pension liabilities or pension obligations will be interest cost. So on the pension obligations, I'm using that same 10% at times the adjusted opening balance. The adjusted opening balance is now 895. At 895. So times the 895. Okay, so this should give me the interest cost. Interest cost. So on my calculator, 10% of 895 is 90. If you round it off, it's 89.5, round it off to 90. You realize that our interest income of 95 is bigger than the interest cost of 90. So we have a net interest income. So we have a net interest income. That net interest income is the difference between 95 minus the 90. 95 minus the 90. So in that idea, this is net interest cost, stock net interest income. It ended up being net interest income. So that net interest income of 5. So that net interest income is 5, which I am going to credit. Let me start with the debit. Let me hang the debit there. But the credit is going to go to the P&L. The P&L, in this case, that's going to be the consolidated retained earnings. Consolidated retained earnings with 5. Okay, while the debit is going to go to the net pension asset account. So my net pension asset, which is this column, this last column here, the net pension asset, I'm going to have a 5 there. So I say I have a 5 there. But then you needed to keep picking these figures here. So I had a 441. This was a 0 because this balance off. Then because we are moving asset side, that's why you see 441 is a positive because from the asset side, while 252 is going to be a negative. It reduces the net pension asset. 52 there. Okay, now I have a 5 there. Okay, so that's the fifth adjustment. It's a 5, a net interest income. So mean that I have debited the asset account. What I've not yet done is to run this credit. So I'll post it later. So I've highlighted those that I'm going to complete the double entry later. But that's item number 5. Now I come to item number 6, which is the remeasurement adjustment. But before that, I'll get my book carrying amounts. Remember yesterday, that those book carrying amount at their end, 31st October 2022. So I'll start with the pension assets, right from the adjusted figures here, using my calculator. So it's going to be 945 plus 441 minus 630 plus
There is
95.
a problem on net interest cost. I think it is not 90, it is 89.5.
Okay, so you see what is going to happen to people in the exams. Again, the examiner will not shout to say that, please, all your calculations should be rounded. Those things happen, you guys. And the personal marks will quickly say 0 when you put 895 because you have disobeyed the word that ignored the small points. Those people are going to be there. Like I will keep telling you, they will not have read this part here when they are doing their answer. So yes, it's correct to say 89.5, but you're doing against the instruction because you're now starting to put decimal points when they refused you. So those things are very, so to be honest, it's not that you didn't read the instruction, but you can easily forget it. You can easily forget. So that's why continued practice between now and the exam is to keep putting you alert that I need, like that mistake you've done, you'll not repeat it now because you've learned it, that I need to keep reading the instruction. So that lady has said that she will not do that mistake in the exam, I can assure you. She's now going to be sharp to do the right thing because she has known she can easily make a mistake and does not pass the paper because of just saying 0.5. So I'm picking the 90 because I'm rounding it off, because of the instruction. I hope you've understood. Okay, so I was picking these figures and I saw the total I have on the pension assets on my calculator is at the end of the year is 851. So that's the total book carrying amount I have. Let me also do it for the pension obligations, starting with 895 minus 630 plus 252 plus 90, and also see what the calculator has. 895 minus 630, then plus 252, then plus 90. I have a 607. So I'll come and put my 607 here. Okay. So mean that in net, I have 851 minus 607. So 851, sorry, minus 607. I have a net of 244 book value. 441 minus 252 plus 5, you should still be able to get 244. Yet they've told me that the market fair values, the market fair values at 31st October 2022 have been given. So let's go back in that note to say what's the market fair value. The market fair value in that note was that for pension obligations, 731. That's the market fair value at the end of the year. And the market fair value for the asset is 882 at the end of the year. So let's pick 731 and 8882. 8882 is for assets and 731 is for the pension obligations. Okay. Picking 882 for the assets and 731 the pension obligations, mean that at the end of the year, the net pension asset should be 882 minus 731. So a figure of 151. 151 is your net pension asset. So mean that the difference here, the differences between the book carrying amount values are what we call the remeasurement adjustments. So we have a remeasurement adjustment, which is now your number 6. Remeasurement adjustments. So which are called number 6. It's changing the year. At the end of the year is that remeasurement adjustment now. Okay. Okay, somebody is asking, why are we not using 12%? If somebody can help me, he's saying that, why have you used 10%, not 12%? That person, I think, was not in our class yesterday, or has not even been in here when I was explaining it. If I can get a volunteer to say, why did you use the interest rate at the start of the year to compute net interest compared to the interest rate at the end of the year? Can somebody help me? Because then this person did not attend the class yesterday.
It is easy to use it at the start of the year, not the end of the year.
Notes. Okay, you want to tell the person yesterday's class. Somebody wants to talk. That person has not been in class since yesterday, or was watching football maybe yesterday, so he has now joined after the football match. He's now wondering why. You see, he has taken us back. If he has been on football, I'm sure he could even have been on football. So he has finished the match, so he's now back. So let's go back and respect him or her. So the statement I've put here, you compute net interest cost or net interest income based on discount rate at the start of the year, not interest rate at the end of the year. The question here has told me the interest rate at the start of the year. The start of the year is from last year, October 2021, is 1st November 2021. The interest rate is 10%, not at the end of the year, which is 12%. And the English word here is respectively, implies that that 12% is for end of year. So 10% and 12%, they have given you the English word respectively, because October 2021 and October 2022, they're saying 10 and 12, so respectively. In English, it means that 10% is for 2021 then, while 12% is for 2022. Because I can see the person is supporting it because they did not put that 10% near and immediately on this date here, but does not see the word respectively here. Okay, fine. So let's move back. I think by the time we move to that person, we're looking at completing that table. And we're looking at now change or adjustment number 6. Okay, so back down there, we're working on number 6, sorry, number 7. Oh yeah, adjustment number 6. So we're going to do a mathematical difference between the book value and the fair value for assets. So starting with assets, 882 minus 851 plus the assets have a remeasurement difference of 31. So that 31 is a remeasurement gain. So I mean that on the pension assets, we have the difference between 882 minus 851. Please, everyone assets increase from 851 to 882, then that's a measurement gain. So we have a gain of 31. Okay. Now for the pension obligations, we also have a measurement adjustment, which if it was 607 in the books of accounts as carrying amount, the market says it should be 731. So we're going to say 731 minus 607. That's 607. Okay. 731 minus 607. I have a 124. I have a 124. Now that 124, is it a gain? Is it a loss? If your liabilities go up from the book figure of 607 to what the market says is your liability 731, it's a loss. You have more liabilities to pay. So this is a loss. So, okay. So if this is a gain, on 31, and this is a loss of 124, then we have a net loss. So it means that we have a net remeasurement loss. Net measurement loss. The difference between 124 minus 31. So that net remeasurement loss of 124 minus 31 is 93. So it's at 93. We have a 93, which is a net loss. So that 93, I'll put it in the column for the net. So 93, which is a net loss, a net remeasurement loss. So the question is, how do we account for the net remeasurement loss? We are going to debit it in the OCI. So we are going to look for the OCI. Remember, we're not paying a P&L and OCI. So instead of debiting it to the OCI, we shall take it to what we call other reserves. Other reserves in the balance sheet of the group. So that will be 93, while the credit is going to go to the net pension asset. So that credit, the net pension asset, and that's why we are saying minus on the net pension asset, 93. So that debit is what I'll deal with later when I come to complete the double entry. But the credit, we've done it here. Now, however, just when we are about to say that we are taking our pension scheme on a net asset position of 151, they've told us you can only recover 70%. So we have an asset ceiling as our number 7. So we shall say, however, at the reporting date, we have an asset ceiling. So our asset ceiling is only 70%. So that we are calculating it for the examiner to give you a calculation mark. So 70% of the 151 is what you can recover. So what is that 70% of 151? So 70% of 151 is 106. So from the information, cover 106 instead of, rather than the full 151. Asset, net pension asset of 151 can only recover 106. So what does that mean? It means that there's going to be an impairment loss. An impairment loss on the net pension asset. The net pension asset. And that impairment loss is mathematically the difference between the 151, which you thought you can get, but minus 106, which you can only recover. You have another calculation mark to say 151 minus 106. I have a 45 that I cannot recover. 45 million. So how do I deal with the 45 million? I am going to debit that 45 million in the group OCI. But because I don't have an OCI to prepare, I am going to take it again to other reserves. 45. While the credit, I'm going to go to this that's impaired, reducing the net pension asset.